FedEx shares are trading higher this morning after beating expectations, it says here. Actually, it says an earnings beat, which is a noun somehow. Brandon Oglenski, Barclays Senior Airlines and Transportation Analyst, joins us. Okay, so what was in here that was surprising to the street and to you?
Hey Joe. Hey, Becky. Good morning. Great question. I think the surprise here was not so much that they technically beat the quarter. People got negative. There was some weather events, ice in Memphis in January, which typically will make their airline lose a little bit of money. But I think the bigger issue here is that incrementally they cut some costs and committed to getting about $2 billion out incrementally next year. And more importantly, they're moving to FedEx One next year, which is literally merging express and ground delivery operations here in the U.S. For customers, that's going to be a big change because today, if you ship express and ground, 2 trucks show up, 2 different pickups. So it's going to go to 1 pickup starting maybe next year, and over the course of the next 2 to 3 years, it's going to merge into one FedEx. I think that's why people are really excited here.
That might explain it. It's kind of weird that the world leader in logistics, and they have to. I mean, just watching this company over the years, the way that it has managed itself, and Fred Smith there, so they've still got logistics that they can streamline.
Well, and Fred Smith is a great guy, but they've run separate operations for about 30 years between ground and express. Whereas if you look outside today, you'll see a UPS truck. Express and ground packages go on the same network there. That's what FedEx is pushing towards. So a company that's earning, it's called around $6 billion of operating profit today. We see duplicative costs in the networks conservatively of about $6 billion. That's very similar to what management's targeting to get out by fiscal 27, so about 3 years from now. I mean, we're talking about potentially a doubling of earnings. It could be very big for the stock.
Yeah. It had the same multiple. When they said demand, in spite of demand, we just had someone talking about how strong demand is we're looking for weakness in the economy, having trouble finding as much weakness as we had expected by now. What are they talking about?
Well, overnight shipments were down about 3%. Ground shipments were actually flat. So we were looking for a little bit better there. But I think the retail supply chain is finally getting back to life. I mean, I think LA, Long Beach imports are up probably 30 or even greater than 40% in February. So the retail supply chain really contracted for about 12 to 18 months as we destocked. I mean, I know we're talking about Lululemon and Nike this morning, but we do think the consumers actually have a pretty good track. And this is just going to feed into better fundamental outcomes for the company looking forward.
Because you watch the transportation group, and we can glean things about the overall economy from the Dow Transports, right? What is it telling us, the demand picture? I
mean, railroad volume for the first time is up the last 2 quarters after contracting for about 2 years. And again, I think a lot of that was driven by retail destocking because the supply chain just got whipsawed so much during the pandemic. Everyone thought, goods consumption is going to be up 10%. They extrapolated. We brought too much inventory into this country. Now we just went through a very big correction. So arguably, we've been in a freight recession now for over a year. I think we're finally exiting that.
And as far as margins go, what could the company hope for with some of the things you're talking about?
Well, consolidate, because they're about to financially merge their ground and express operations. Ground generates a 10 or 11% margin, which is okay. The express business is still at like 2 or 3%. Wow. And so the opportunity is really to get that to a mid-teens level. That's where I think you actually generate an adequate return on capital.
How did it get to that point? Was this just pandemic stuff? You hired a lot of people and made sure you were getting things there when a huge surge in demand came through?
Well, that's part of it, Becky. But honestly, if we go back in the history of this company 30 years, express profitability has probably averaged around 5 or 6%. In the good years, they can do 8. But we'd argue that's really never earned its cost of capital. And I think the big reason has been the separate ground and express operations. Yeah. So as they look to merge those, I think that's where the real margin opportunity is.
We had the pilots here yesterday, the pilots union for FedEx. What are labor issues right now at FedEx? And just how about workers?
Well, this is a pretty important distinction between FedEx and UPS. So on the pilots, that is one of their biggest unions, or one of their only unions here in the U.S. The rest of the employee groups are actually not represented. I understand the pilots' issues here. I mean, there's a little bit less flying going on because obviously what we peaked during the pandemic, that's come down. But they're also without a contract now for a couple of years. So I think that's important to them. But more broadly, as they look to merge these operations, I think there's going to be a lot of headcount reduction through attrition, especially of frontline employees. which is just to get the company much more efficient, much more sustainable. I think it actually creates a pretty good growth platform for them. So they're going to compete with a non-union workforce versus a unionized workforce at UPS. This is a pretty important distinction. Because if you look at the less than truckload carriers right now that we cover, it's a small freight business. But effectively, the non-union carriers have really taken a lot of share from what was once a very heavily unionized business.
Yellow?
Yep, that's right. Well, Yellow's out of business now.
Yeah.
So
Why? But no, why have they taken share?
it really comes down to pay rates for union versus non-union carrier are actually very similar. We think it comes down to work rules. If you're going to make a lot of money as a driver, can we ask you to do a local run versus an over-the-road run, or maybe potentially help out in the terminal? If you're a unionized employee, your job is very strictly defined. So we think that's just really impacted service over the years. So the non-union carriers are generally providing better customer service, and that's how they're winning share.